Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. A real pleasure of mine tonight to be interviewing Jeff Rubin. He is a former chief economist at CIBC. He's just recently come out with another book. I had the privilege of hearing him present at the Rutman School of Business about a month ago on this book and about some of his current thoughts. And it's really quite fascinating. He takes a slightly different view, frankly, in places a very different view than some of the other economists that we've interviewed on the show. And so I thought it'd be great to have him on the show. He's also someone that I've followed over the years. He was reputed to be the one person that called for the housing crash back, when was it? 1990, I think it was.
Yes, a long time ago.
It's a while ago. But Jeff, one of those people that really understands what's going on in the economy in Canada and worldwide. Welcome to the show, sir.
My pleasure.
So tell me, what's the title of the book and what's its thesis? It's different than a lot of books that have come out recently. You're very negative on the changes with globalization, the impact on inflation. You had a really interesting comment on money supply. Tell us a little bit about the book.
Well, the book talks about how the global economy has changed in a fashion that we have not seen for decades. And we were told, of course, that globalization was both beneficial, but maybe most importantly, inevitable, and that there was nothing that we could do to reverse that. We saw during the COVID economic lockdowns that globalization wasn't so inevitable. So-called just-in-time supply chains became just too late. And we weren't talking about lawn chairs or tennis shoes. We were talking about desperately needed ventilators and vaccines during the worst public health crisis since the Spanish flu around the time of the First World War. So that was the first real challenge or assault on globalization that got people thinking, is it really so optimal to be so dependent on far-flung supply chains? The pandemic, as traumatic as it was, and economies all around the world were locked down, was really a black swan event. It was traumatic but fleeting. But what has now happened is not something so fleeting. What has happened now is a fundamental change in how the global economy operates. And what I'm talking about is the pervasive use of sanctions, otherwise known as economic warfare. And that is totally changing the way the global economy operates. And those changes reverberate back to you anytime you go into a grocery store or fill up your tank. That instead of a unified, seamless global economy where capital and technology and goods trade seamlessly, we now have a global economy that is fractured. It is fractured into opposing geopolitical blocs. Now, in some places, that warfare is military. Right now, Ukraine, perhaps soon Taiwan. But in all places, it's economic. That sanctions have become the new normal. And that has with it all kinds of profound changes as so-called friendshoring replaces offshore.
Now, the CHIP Act in the United States and President Biden's efforts in that regard would suggest that that's good. It's bringing back, high-paid jobs to the United States. It's giving us in the United States and Canada, a manufacturing base that we didn't have. So is it bad, or is it just inflationary, or what's your concern with these economic sanctions?
Whether it's bad or good, very much depends on who you are. Okay, if you are one of the few remaining members of the middle class that once had high-paying factory jobs that were shipped over to China, where workers made 1/10 of your wage, It's not only good, it's a miracle. It's a miracle that no one expected, because no one in their right minds would have expected that those jobs would ever return home because of the wage gap. So, for example, last year, counting signing bonuses, wage settlements of unionized workers in the United States rose by 7.3%. You've got to go back to 1988, the last time wage settlements grew like that. Why did they grow like that? Because all of a sudden, you couldn't close that factory down when workers went on strike and move it to China, because China is an enemy. And the whole idea with friendshoring, as Janet Yellen has described it, is you don't trade with your enemies, you trade with your friends. The only problem with that is that all of America's friends, like Canada, Australia, Japan, Western Europe, are very high wage economies, like the last place a company like Apple would wish to locate its production. So if you are a worker, if you are a member of the middle class, this is a reprieve, because globalization was a death sentence. And there's no question that, we're seeing wage settlements, strike activity, union membership grow at rates that we have not seen for decades, because none of those things were compatible in a world of globalization. But if you are a consumer or a borrower, whole other story. If you are a consumer, recognize that everything from an integrated circuit to a toaster is going to cost a multiple. Let me repeat, a multiple of what it cost when it was manufactured in China. So for Western consumers, who have depended so heavily on consuming the fruits of cheap overseas labor, it's going to be quite a shock. And of course, with inflation comes interest rates. Okay, a record low inflation brings record low interest rates, particularly when central banks like the Federal Reserve Board and the Bank of Canada are printing money like mad. But with inflation comes much higher interest rates. During the pandemic, we had people buy homes at like a sub 2% 5-year fixed mortgage rate. Well, may I suggest that there were many households who normally could not have afforded to buy a home and should not have been in the housing market at regular mortgage rates, who were allowed to do those things at record low mortgage rates. The only problem is that when those people have to refinance, they're facing monthly mortgage payments increases of 40%. And for many of them, their mortgages are what is called negative amortization. In fact, there's about $130 billion of residential mortgages held by my alma mater, CIBC, TD, and BMO, that now the monthly payment doesn't even cover the full interest cost, let alone paying down any principal. And the unpaid interest is simply capitalized, so that instead of paying off your mortgage over time, your mortgage grows bigger over time. For those people, the change in global supply lines and the accompanying increases in inflation is not beneficial. There will be less people who will be able to qualify for mortgage financing than in the past. So again, in answer to your question, are these changes good or are these changes bad? It very much depends on who you are.
The 130 billion, is that just in Canada?
Yes. It's about 20% of the entire stock of residential mortgages in Canada.
That are negative amortization and or not even paying the full interest.
Well, that's what negative amortization means, that your monthly payment doesn't even cover the full interest cost, no principal, so that the unpaid interest gets capitalized or added on to your mortgage, so that your mortgage actually increases in size. The danger with that, and probably this does not sit well with the superintendent of financial institutions, is the last time that the market had that kind of characteristic in it was during the mortgage resets of some subprime mortgages in 2007, 2008. Because when people's equity is entirely hollowed out by soaring interest costs and housing prices are falling at the same time, they're more inclined to mail in the keys than a check to their mortgage company.
But very difficult for people to mail in the keys in Canada, is it not? In the United States, there's non-recourse financing against homes, and so you can mail in the keys and leave your debt behind. In Canada, that's very difficult, is it not?
Well, I mean, it's more difficult, but hey, when you can't afford to pay, you're not going to pay. And even quite apart from not paying, you may not qualify for a mortgage anymore when the resets come, because don't forget, not only have mortgage rates increased by hundreds of basis points, but now you have to meet a stress test. And a stress test is to see whether you could meet the new mortgage rate plus 200 basis points. I bet many of the people who financed their mortgage during the pandemic at these ludicrously low rates will not qualify for mortgage financing when they have to renew.
I got an email this morning about a developer that was actually asking people to make payments against their commitments for purchases of pre-construction condos. They bought pre-construction condos,
Right.
and they were coming to close, and the developer was saying, pay us money comparable, frankly, to the amount that the deposit that they already made and lost. Otherwise, we'll sue you if you don't close. So that they're actually charging people monies that they're just going to have to walk away with, so that the developer doesn't come after them and sue them for not closing.
Right. So all of these are manifestations of market stresses. Just like there's right now about 60 major condo projects that have been put on hold. And there's financing implications of that. And just like, there's something like 3 billion square feet of downtown office space that's vacant in North America, and there's consequences to that. So all of these things are really signs of financial pressures. And of course, those financial pressures can be walked back to the broader things that I'm talking about, like economic warfare. Because when you sanction the world's largest energy exporter and the world's largest grain exporter, there are consequences for the prices of alternative supply. And we see those consequences anytime we walk into a grocery store or we fill up our tank. And now, unlike in the past, wages have bargaining power, and workers are going to chase and want to be compensated for those huge increases in food and energy prices. And therein lies the dynamics of the dreaded wage price spiral that made inflation so difficult to tame during the 70s.
We're going to take a break for some messages and be back in just 2 minutes with Jeff Rubin, author of a brand new book on the economy. He's really brought forward a bunch of concerns that not a lot of other people have mentioned, and he's a gentleman that needs to be listened to. Stay with us, everyone. We'll be back in just 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Jeff Rubin. He's an economist. He's an author. He's someone that I've had the pleasure of following over the years. Back in 1990, as I mentioned earlier, he was the one individual that called for a housing crash, and he was right. And a lot of people thought he was wrong in that regard, but he proved to be completely accurate. So someone that we should be listening to. And I haven't finished his book. I did buy it and read the first third of it and found it really quite fascinating. One of the things that you talk about in the book that I really wanted to focus on, and you talked about in your presentation, that not a lot of people have talked about, is effectively that you thought that Milton Friedman, I guess, and the Chicago sort of School of Economics were right. And you said that the inflation that has occurred over the course of the last couple of years is because of the increase in the money supply. And I think a lot of people don't understand that. Could you please explain, if you could, why, I think a lot of people thought it was deficit spending and Keynesian economics, with the pandemic that caused inflation. And you were talking about how it was primarily the increase in the money supply that caused inflation. Could you explain that to everyone, please?
Right. Well, Milton Friedman, who is the father of the Monitor School of Economics, I wasn't always a fan, but in this case, I'm in agreement with him. His famous dictum was, inflation is everywhere and at all times a monetary phenomenon. And nowhere was that truer than during the pandemic. The money supply exploded. I mean, we're talking M1, which is the narrow measure of money, grew by 40% during the pandemic, about 6 to 7 times its rate of normal monetary growth in Canada, and similarly happened in the United States. That's why, despite racking up an over $300 billion deficit, which Chrystia Freeland did during the depths of the pandemic, the yield on a 10-year Canada fell to an all-time low of 0.5%. Now, in my 20 years as the chief economist of CIBC World Markets, one of my primary jobs was to go around the world and help sell Government of Canada bonds, because that's what chief economists of investment banks are supposed to do. So after every budget, I would, schlep out Kuwait Investment Fund, People's Bank of China, the Landesbanks in Germany, and talk about what a great job the government's doing. The one key factor about bonds and about government spending is the bigger the borrowing program, the higher the yield the government has to pay bondholders. The concept's called demand and supply, and it works setting the price of Government Canada bonds as it does the price of everything else. So, and that's, of course, what keeps government spending in check, because if it gets out of check, then all of a sudden the cost of borrowing is going to go up huge, and taxpayers' dollars are going to go to bondholders instead of paying for vote-getting program spending. So you might expect that when the deficit explodes from 30 billion to 330 billion, that the cost of borrowing for the Government of Canada would explode as well. But the opposite happened. It plummeted. It plummeted to all-time lows. And in fact, the percentage of revenue that was going to debt servicing costs, as Chrystia Freeland gloated at the time, was also at record lows. But what she didn't mention was who was buying the bonds, because it wasn't insurance companies or pension plans who were the normal purchasers of bonds, or even retail investors. It was the Bank of Canada. They were buying $3 billion a week. By the end of the pandemic, they owned almost half of the entire stock of Government Canada bonds. Now, unlike a pension plan or a retail investor, the Bank of Canada didn't think that it had to worry about portfolio performance. And let me just explain to your viewership, I don't know how much of a fixed income audience you have, but the price of a bond and the yield of a bond are inversely related. So when a 10-year Canada pays a 0.5% yield, its price is way, way above par. Well, what that means is that the cost of the Bank of Canada buying all these bonds is they have billions and billions and billions of losses on their bloated balance sheet because the price of a 10-year Canada is no longer a 0.5%. It's about, I don't know, 3.5, 3.75, something like that. I mean, the yield, and the price has fallen markedly. So all that liquidity sloshing around in the system because the printing presses were working overtime created a powder keg, and sanctions against the largest resource producer in the world, and now sanctions against the largest manufacturing exporter in the world, China, have blown that powder keg sky high.
So there's a lot of losses on the Canadian, the Bank of Canada books.
And the Federal Reserve Board and the Bank of England and the Reserve Bank of Australia. And what was really telling is when the governor of the Reserve Bank of Australia acknowledged that at the time the bond position of the Australian central banks was a $36 billion loss. And what would they do about that? Well, there's two ways of doing that. I mean, either the Department of Finance or the Treasury bails out the central bank losses with taxpayers' money. That's option A. Or option B is to do what created the problem in the first place: just print more money. And that's exactly what the Reserve Bank of Australia said they would do. But if they're going to print way more money to pay for these losses, what does that say about future inflation?
So this is not just something that happened in Canada, it happened around
Absolutely not. This is the same in the Federal Reserve Board, the Reserve Bank of Australia, the European Central Bank, the Bank of England. But I will say one thing: no deficit proportionately grew as large during the pandemic as Canada's.
In GDP terms or per capita terms? Or
In percentage terms. In percentage terms. I mean, the deficit went from 30 billion, give or take, to over 300 billion. That's a 10 times increase.
These losses are what, 5 and 10-year bonds that they purchased?
Well, I mean, the losses are all through the yield curve, but of course, the price action from an increase in yields is much greater on a long-term bond than on a government bond. Now, until these bonds mature, they don't have to write down the losses. They will mature over time. But we are talking about billions and billions of dollars of losses. And as I say, there's two ways they can be resolved. Either the Department of Finance can write them a check of taxpayers' money, which is going to be highly unlikely, or they'll just print money. And by printing money, they'll cover the losses.
So unlike a pension fund or a public company, you're saying they don't have to market it on a regular basis.
Now, if they were Silicon Valley Bank, for example, they had the same problem. They bought all these treasuries during the depth of the pandemic, and now they've sustained huge losses, and they would have been insolvent had they not been bought out by a bigger bank. Now, that's different because Silicon Valley Bank, or for that matter, even JP Morgan, can't print money. The Bank of Canada, the Fed, the Reserve Bank of Australia, they can all print money.
So I was at a presentation by the current chief economist at CIBC, and he was saying that the inflation during the last couple of years was primarily a supply chain issue. The supply chain issue has really been solved. That inflation X housing costs is less than 2% right now, and it's only above 2% because of housing costs. And so therefore he was suggesting inflation will come down and interest rates will come down. Your
Well,
contrary position.
Avery, who was the deputy economist when I was there, sees things very differently than I. The supply chain issues have been solved. Well, yes, if you're a North American worker, as we've discussed, they've been solved. But they haven't been solved from an inflation perspective because supply chains are not going back to where they were that held inflation in check for the last 30 years. They're not going back to China. They're coming here. And, I don't know if Avery's noticed, but here is a whole different labor force. Like, for example, have you bought a bottle of wine recently?
I have.
Not recently, because the LCBO has been on strike for the
I
last.
bought it at duty free.
Okay, there you go. This is a different labor market than the Chinese labor market, okay? This is a labor market where labor is very expensive. And labor feels that it needs to catch up because wages have trailed inflation. So the supply chain issues that Avery thinks are fixed from the perspective of organized labor in North America, but I don't think they're fixed at all from the perspective of North American consumers. So therefore, they shouldn't have been thought of as fixed from the perspective of North American central banks.
So because of the sanctions, the economic sanctions worldwide, and the supply chain issues that you're saying are going to be, forever, or at least in the medium term, impacted. And because of the growth in the money supply that you say has created these losses that are going to have to be funded by way of money being printed in the future, creating more inflation in the future. You must believe that interest rates are not going to come down, or at least not going to come down to the extent that some of the current chief economists of major banks are suggesting they're going to.
Right. And I will address that, but let me just back up for a sec, because I think everybody will agree that the future path of interest rates will be set by inflation. I think everybody will agree with that. My problem with inflation is, how do you get 2% inflation when wages are growing at 6%? Because wages just don't affect the price of food and oil. Wages affect the price of everything. Now, to getting to your question, do I think that interest rates will rise? Yes, and let's talk about mortgage rates, because that's probably the most important interest rate in the economy, because that's where people borrow the most, okay? Mortgage rates are priced off the Government of Canada yield curve. I mean, with a huge spread, but nevertheless, changes in mortgage rates reflect underlying movements in government bond yields. The yield curve is inverted right now. That's a very dangerous place to be if you're a mortgage holder. What do I mean by yield curve inversion? Well, I mean that the price of longer term bonds, like 5 or 10-year bonds, is actually well below the Bank of Canada's overnight target rate, which is around 4 3/4. Usually, a yield curve inversion occurs on the eve of a recession, because the bond market is quite rightfully anticipating that the central bank will cut interest rates to stimulate the economy in a recession. No one's expecting a recession. Yet people continue to believe that the central bank will cut multiple times, simply because the central bank had raised rates so much before. But what people aren't recognizing was they were raising rates from levels that were an anomaly. They were an all-time historic low because it was the central banks themselves that were buying the bonds. If inflation does not allow the Bank of Canada or the Federal Reserve Board to cut interest rates multiple times, as is priced into the bond market, the yield curve will not stay inverted. In which case, a 5-year government bond yield, which is I'm right now maybe 100 basis points below the overnight rate, will go back to its normal position of maybe 100 basis points above the overnight rate. That's a 200 basis point swing in the 5-year government bond yield. That will be reflected in what a 5-year fixed rate mortgage will be. If that happens, we're not looking at 5% 5-year fixed term mortgages. We might be looking at 7%. And then I go back to my earlier comment that, mortgage rates are a gatekeeper to the mortgage markets. If we see that kind of backup in mortgage rates, that gate will close on many homeowners.
So therefore, the obvious question is what's going to happen to housing prices? Let's take a break for some messages and come back with Jeff Rubin in just 2 minutes and ask him what he thinks about the real estate market. Stay with us, everyone. Back in 2. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Jeff Rubin. He's the former chief economist at CIBC World Markets. He's currently the author of a great new book on the economy. Jeff, what's the name of the book and where can people get it?
It's called A Map of the New Normal. And it's how inflation, war, and sanctions will change your world forever. The publisher is Penguin Random House. Probably the cheapest place to get it is Amazon. But it's sold in all bookstores in this.
So in 1990, you called for a housing collapse, and you were
25% decline. It wasn't appreciated by my bank at the time.
And you were one of the only people, if not the only person, that called that.
Indeed.
And you were right in that regard. So I got to ask you what you think about the current situation. And let me preface that by saying, this past week, I've done 2 shows on condo crash, and I've had people that are knowledgeable in pre-construction condos and what's going on, and have said that it's actually a crash, and that the average price of a pre-construction condo in the Greater Toronto area was about $1,200 a square foot when bought 2 or 3 or 4 years ago, and are now trading below $1,000, some in the $970 dollars per square foot. So, that would be a 20% or more decline in condo prices, and that the resale price of condos is frankly even below that on a per square foot basis, suggesting that there's 28 months of condo inventory in the marketplace, the highest that there's been, one person told me, in 2 decades, and that the typical would be sort of 8 months of condo inventory. So a fairly substantial amount of listings. But they said the crash in condos has not yet gone on to single family homes. So I ask you, what do you think is going to happen in the real estate market in the Greater Toronto area?
Well, first of all, let me talk about what I think is the most exposed, which is not the condo market nor detached homes. Let's talk about those empty caverns downtown, those bank towers, and what's underneath those bank towers and who's in those bank towers. Because if you were to go down on a Monday or a Friday down in First Canadian Place or Brookfield Place, you would think it's a public holiday because nobody's there. And every third storefront has a for lease sign. You're talking about office vacancy rates that downtown are 20% plus compared to 3% pre-COVID. And what's happened is that long after there's no longer any public health rationale for working at home seems to have become a permanent feature of our labor market, which means that typically, like at places like CIBC or Bank of Nova Scotia, instead of working 5 days in the office, you're at most working 3 days in the office. And that's left CIBC and all the other banks with all this huge and unnecessary office space that they're, anxiously trying to sublease. But the problem is that everybody's in that boat. What we've got to do, and reflecting that, is that if you look at, say, the value of office REITs like allied properties, for example. They're down about 30–40%. So what we've got to do is find a way of converting all of that unused office space into some other means. And certainly residential rental would be a fantastic solution to that, except for what's involved. And let me give you an example. My office used to be at CIBC World Markets, used to be on the trading floor. And there might have been 2 sets of washrooms on the trading floor for 200 people. Okay. Now, all of a sudden, if they took everything out, they might put in 20 condos on that floor. But each condo would want 2 washrooms. So all of a sudden, instead of like 2 main sets of washrooms, you've got 40 washrooms. So in other words, what I'm trying to say is the conversion is not an easy thing to do, yet the longer that this goes on, the economics compel that conversion. And, this is not without financial consequences, because somebody's financing all of that office space. And at today's rents, I'm not sure that financing is secure. Now, you want to talk about residential, and I think you quite rightly point out that detached homes have not felt the same price pressures as condos, although it's not exactly like single homes prices are soaring at this time.
I'm told that listings are currently at an all-time high.
Listings, right.
And homes are on the market a long time, but that prices haven't come down. They may be flat, but they haven't come down.
But they're not going up either, is the point. And that's all going to be a function of mortgage rates. I mean, it's a pretty simple relationship. Just like in a bond, lower the yield, higher the price. Well, in the real estate market, higher the mortgage rate, lower the value of the property that it's financing. So I guess to answer your question, Brian, where residential single detached will go, not so much relative to office or condo, but judged on its own platform, will depend on mortgage rates. I think that mortgage rates are going to be higher. I think mortgage rates are going to be higher because I don't think inflation will allow the Bank of Canada to cut interest rates as many times as is currently priced into an inverted yield curve. And as I said before, if the yield curve inversion does not last, then, bond yields have a lot of room to rise, and that will be reflected in the price of mortgage rates.
Now, your view is a contrary view. The market is betting that interest rates will come down. Most economists that I've read or spoken to think that interest rates will come down. The chief economist at CIBC was suggesting 2 or 3 rate cuts this year and more next year. So if your contrarian view is right and everyone else is expecting something different, what's the implication?
For them or for me?
For the market?
For me, probably good. Why, maybe more importantly, why do I have this view versus other people? Because the other people think the world will continue to operate the way the world has operated for the last 30 to 40 years. And if you look at the size of the run-up in interest rates, then it would be normal to expect interest rates declines. And if you think that the run-up of inflation was simply because of food and oil prices, which initially started it, then you would expect inflation to fall. I don't think the world's the same. I think the world's fundamentally changed. And what's changed the most is we've lost the single biggest brake on inflation in the last 30 to 40 years, and that's offshoring. That's the ability to move production from high-wage labor markets to low-wage markets. And we can't do that anymore. And unlike COVID, that's not a black swan. That's not a temporary fleeting event. That's permanent. That's part of the new normal. That's what they don't get.
Are we headed for a recession?
Ultimately we'll be for a recession, but I don't see, I mean, normally, as I pointed out, Brian, normally recession is the context for an inverted yield curve because it would justify market expectations of significant interest rate cuts. Right now, no one's expecting a recession. Is Avery or any of his fellow chief economists at the bank expecting a recession? No, but yet they're expecting the central bank to cut interest rates as if there was. I think that's a bit of a disconnect.
So that the announcement that was made was that on a per capita basis, we're in a recession. So that
Okay, but that's okay. Let's just call a spade a spade. A recession is multiple quarters of GDP contraction. We're not there yet. Now, Brian, if you're going to ask me, will we ever be there? Of course we'll be there. But right now, there's no basis for an inverted yield curve, which is an imminent recession. So, is the inversion in the yield curve sustainable over the next 12 months? And I'll tell you, Brian, and you probably track this better than me, but at the beginning of the year, there was like expectations of 6 interest rate cuts beginning in like March and April. And you notice all that continually gets pushed back and the number of cuts gets, reduced. I think, as we go forward in time and core inflation driven by rising wages proves to be very resilient, we're going to see the market scale back its expectations of rate cuts, and we're going to see an inverted yield curve gradually move to a positive slope. And that would have a huge impact on mortgage rates.
But I guess this is my question. It's because what happens is important, but what happens versus expectations is even more important. And if the expectations aren't that, things are going to continue as they are, but the expectation is that interest rates and inflation are both going to go down. And what you're saying is that's not going to happen. So everyone's expectation is going to change. And,
Right.
And over the course of the next, 6 months or so, people's expectations
will adapt to what they see in the economy.
But that's got to mean, doesn't it, that housing prices are going to go down?
Well, I don't know if they're going to go down, but they sure as hell ain't going to go up. Right?
It's going to be an interesting. It's going to be an interesting.
It's going to be interesting for a lot of things, and it's, of course, not just the housing market. I mean, an even bigger beneficiary of expectations of interest rates going down isn't just housing prices; it's stock prices. Okay,
which are at an all-time high right now.
Bonds and equities compete in anybody's portfolio, right? So, when I say interest rates going up, I don't necessarily mean the overnight target rate. I mean bond yields. If the curve doesn't remain inverted, which is, good news for tech stocks and other stocks, and goes back to a positive slope, what are the implications, not just for housing prices, what are the implications for stocks?
We're going to take a final break for some messages and come back with some concluding comments with Jeff Rubin in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. Really interesting conversation tonight with Jeff Rubin, former chief economist at CIBC, current author of a great new book that I highly recommend. Jeff, remind everyone the name of the book.
A Map of the New Normal. And it's about how inflation, war, and sanctions will change your life forever.
So let's
go
on
that score, we have not yet seen all the contours of this new map. But one thing that's, I think, already clear as we head inevitably along this course of global conflict and profound economic change, we're not going back to the world we once knew because simply it no longer exists.
Jeff Rubin, thank you so much for joining. Really appreciate it.
My pleasure, Brian.
Interesting conversation. Anytime you want to come back, sir, Very provocative conversation. That's my show for tonight, everybody. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. All my podcasts and videos go up on social media, my website, briancrombie.com, and on podcast servers as soon as the radio show goes to air. Good night, everybody. Thank you, Jeff Rubin.